Hello, what is going on, everyone? I hope you're having a great week. Today, I'm going to share with you some ways to reduce your taxes as an employee. And we're going to do that by showing you how to lower your net income. Now, we're not going to actually go over how to reduce the amount of money that you make, but we're going to go over how to reduce the amount of money that you have to report to the government at the end of the year. Because your net income is what the government uses to determine how many taxes that you're going to pay. So if we can find ways to legally lower the amount of net income that you report, I think that's a good thing. I'm sure you've heard the story of how Amazon paid $0 in taxes in 2018. And I'm sure you've also heard how Donald Trump allegedly paid $0 in taxes in 10 of the last 15 years. Now, this was prior to 2017.
That was just fake news.
When you hear that, you kind of think like, why are these big companies not paying any taxes? Why am I, like an average person, paying more money in taxes than Amazon? And the truth is because these are large corporations, right? Amazon and Donald Trump has many different businesses and whatnot. But there's many ways to reduce your taxes as a corporation. There's business losses, there's costs of goods sold, there's operating expenses, there's things like capital cost allowance. All these ways make it really easy for corporations to pay less taxes. Now, when it comes to being an employee, there are still ways that you can reduce your taxes, but they are less known. Now, I actually have the official Income Tax Act with me over at my desk, and we're gonna go over a few sections in there that tell you how you can lower your taxes and ways that you can reduce your net income. Just before we head over to the desk, get this. The average American pays about 29 to 30% in taxes. Now, this is spread out between income tax, Medicare, Social Security, but regardless, they're paying about 1/3 of their income in taxes. So if you work 8 hours a day, let's just say it's 9 a.m. to 5 p.m., between 9 and 11:30, roughly, all that money that you make is going to be going to the government in taxes. So if you show up at your job at 9 o'clock, you don't start making any money for yourself until 11:30. It's kind of a crazy statistic to think about, and it would be really nice if we could just find ways to keep a little bit more money to ourselves, right? At the end of the year, we'd have a little more money to invest, or even just some more spending money, right? I'm sure most of us would be happy with a few extra $1,000s at the end of the year. Okay, so I've made it to my desk here where I have the official Income Tax Act. This is the Canadian edition. Now, if you don't live in Canada, the general principles that I am going to say today will probably still be true, depending on where you live. But some of the specific provisions, they may be different. As an example, we are going to go over Section 8 shortly. Now, the content in Section 8 of the Canadian Income Tax Act, you can probably find in your tax laws or your tax act, but it may not be specifically Section 8. But again, the principles, they'll probably apply to many, many countries around the world. So the first thing that we need to do is we need to look at Section 3 of the Income Tax Act. And this tells us how do we calculate net income. There's 4 steps to that. And once we explain these 4 steps, I'll break down each step and I'll give you certain ways to reduce your income for each of the steps. So Section 3 says that your net income is A, the total of taxpayers' income from office, employment, business, and we're going to focus on employment today, plus B, which is the amount of your taxable capital gains minus your allowable capital losses, minus C, which is deductions, minus D, which is taxpayer losses from business or employment or office property or other. All right, so we're going to look at the first part of the equation, which is the total of taxpayers' income, and we are going to focus on employment. So I'm turning to Section 8 here in the Income Tax Act. And Section 8 allows us to make deductions to our employment income. So I'm going to focus on 3 parts of Section 8. The first one is going to be Section 8(1)(f), and this is sales expenses. So if you work a job and you incur sales expenses that you are not being reimbursed for by your employer, you can take the amount that you spend on sales expenses and subtract that from your employment income, and that new number of net income will be what you report to the government. Now, sales expenses include anything from advertising and promotion. It could be entertainment if you are entertaining potential clients. It includes travel expenses as well. So let's just do an example here. Let's say let's say you're a real estate agent and you want to advertise yourself. You want to put an ad in the paper or online. The amount of money that you spend on the advertising, you can deduct that from your net income. So let's say you spend $1,000 on advertising and promotion, you can deduct that $1,000 from your net income. Now this also includes entertainment, as I mentioned. So if you have a potential client and you're going to take them out to, let's say, a sporting event, and you spend $500 on tickets and $300 on meals there, you can deduct that because it's a sales expense. Now there is an exception. Section 67 of the Income Tax Act says that you can only deduct 50% of entertainment and meals. So if you spent $800 on that client for entertainment and meals, you can deduct $400. And you can also deduct travel expenses, as I mentioned, under 81F. So if you have to drive somewhere to meet a client, the costs associated with the vehicle, you can deduct. Or if you need to stay in a hotel somewhere because your client's out of town, or you need to attend maybe a conference or something, if your employer's not reimbursing you for that, you can deduct that money. Now there is one thing to keep in mind with Section 81F. You're only allowed to deduct up to the amount that you make in commission. Okay, so if you make $5,000 in commission, but you have $10,000 of sales expenses, you can only deduct $5,000 from your net income under Section 81F. Now, there is a way that some people can get around that depending on their job, and that's by taking advantage of Section 81H, which is specifically travel expenses. So if you travel a lot for your job, and again, your employer does not reimburse you, so it could be car costs, it could be hotels or airfare. If you have to maintain a relationship with certain clients that are away from your employer's place of business, you can deduct the travel expenses. Essentially, there is no limit. If you incur those travel expenses for the purpose of employment, you can deduct them. So let's just do a quick example here. Let's say you make $7,000 in the year in commission. Let's say you have $10,000 of travel expenses and you have another $5,000 in advertising and promotion or sales related expenses. Your total from 81F would be $15,000, right? But you can only deduct up to your commission. So you'd only be allowed to deduct $7,000. But if you took advantage of 81H, you would be able to deduct $10,000, okay? And you cannot deduct both. That's one thing I will mention. You cannot deduct 81H and F. So you kind of have to just do the math here and add your totals up and see what's gonna get you the biggest tax break. Now the last part of Section 8 that we are gonna go over is Section 81I. And this allows you to deduct dues and other expenses related to performing duties. So for the dues part, if you have to pay a fee to a union, you can deduct that. Or if you have to pay an annual membership to a professional organization to keep your status recognized, so like a sales license or a consulting license or something like that, you can deduct that from your net income. And another part of 81I is the expenses related to performing duties. So this is a very uncommon one, but if you have an assistant and you pay for your assistant, so if you're like a real estate agent and you pay for someone to come in and help you hand out flyers or whatever, the amount of money that you pay them, you can deduct from your income by way of Section 81I. Now this is uncommon. I've never actually met somebody who is in this situation, but if you are in this situation, this will definitely help you. All right, let's dive into part B of the net income equation. And this is your taxable capital gains, how much they exceed your allowable capital losses. So if you're a retail investor, if you invest in stocks here and there, or your savings account you invest, you should be very aware of this part of the equation, because if you make money on stocks that you buy or sell, or it could be other property, you have to pay income tax on the amount of money that you make on those. So let's do a quick example here. Let's say at the beginning of the year, you invested in 10 stocks. At the end of the year, you sold all 10 of those. If 6 of those stocks went up and you made $1,000 on each of those stocks, you would have a total gain of $6,000. Now, if 4 of those stocks went down and they lost $1,000 when you sold them, you would have lost $4,000 and you would have made $6,000. Now, most people would just look at that and they'd say, okay, I made $6,000, report that on my income, now I'm gonna pay tax on $6,000. But what you can actually do is subtract your losses from your gains. So in this situation, you would only have to pay tax on $2,000 because that's the difference of your gains and your losses. And when it comes to capital gains, you only have to pay tax on 50% of them. So 50% of $2,000, $1,000, that's all you're taxed on. Now let's say that you lost more money than you made. So let's reverse the situation I just mentioned. If you lost $6,000 in the market and you made $4,000, your total would be negative $2,000. Now, unfortunately, part B of the equation, it cannot be less than 0. So you would just report $0 for capital gains. However, there is a loss carryover pool. So if you lost $2,000 in 2021, you can carry that loss over to 2022. So let's say in 2022, you happen to make $2,000, you can actually use the loss from this year and use it to offset the gains from next year. So 2 years in a row, you would have $0 of capital gains. So that's another simple way to reduce your net income. It's always beneficial to keep track of your investments even if you're making small gains. Like if you make, $100 here and there in the stock market, technically you have to pay taxes on those, and your small losses, just use them to offset your gains. It may take a few extra hours of work at the end of the year when you're filling out your tax income, but it will add up eventually, and it will be worth it to save more money. So now let's look at part C of the equation, and this is deductions. Now I'm gonna go over one deduction that's very commonly known, and that's the RRSP. I won't spend too much time on it because you can find videos of it on YouTube and most people know about it. But essentially an RRSP is a savings account, and when you put money into that savings account, the amount that you put in, you are allowed to deduct from your net income. So let's just say, as an example, you made $100,000 in a year from your job. You saved $10,000 of that in your RRSP. You would only be taxed on $90,000 for the year. And not only that, but you'd also have saved $10,000 at the end of the year. So it's a win-win situation. Now, if you're someone who regularly saves in their TFSA or even a non-registered cash account, consider starting to save in an RRSP because of those tax advantages that you get today. Keep in mind, when you withdraw from the RRSP, you will be taxed on that money that you withdraw. So it's more of a tax deferral. It's more of a save money now, pay for it later. But it can really help for people who are in a higher income tax bracket today lower their taxes. And the last part of the equation is taxpayer losses. Now, I know that this is a video mainly for employees, and it's really hard to lose money as an employee. I've actually never heard of a situation where, an employee has lost money. However, if you have a side hustle, which a lot of people do, a lot of people try and pick up something on the side, they try and make a little bit more money. You work 9 to 5 at your job, and you come home and work 5 to 9 for yourself. That's what they say. But if you have a side hustle and you're self-employed in that side hustle, or it's a small business, you can deduct those losses from your income, if you had losses, of course. So if you're working on a side hustle and it took a $1,000 loss in the year, use that $1,000 to reduce your net income. Why not, right? All right, so let's go over a real world example, because I know that it can be confusing when you just hear all this stuff, but let's actually lay it out for you. And by the way, if anything doesn't make sense or you want clarification in something, just place a comment on the video and I'll clarify anything that doesn't make sense to you. So I've got just a piece of paper here that I've written down real world numbers. I'll place them on the screen for you too, so you can follow along. So we're gonna look at two situations, or two persons. How about person A, who doesn't know anything about taxes and also just doesn't care to learn. Maybe they don't think it's worth the time or it's really worth that much money. So this person makes $40,000 a year and they make $7,000 of capital gains, whether it's in the stock market or buying and selling watches, it could be anything. in this situation, that's all they would look at. And they'd say, okay, income of $47,000, that's what I'm gonna be taxed on. Now for person B, they would look at a lot more than just that. So if person B makes $40,000 a year, but they actually spent $5,000 traveling for their job that they didn't get reimbursed for, they know that, okay, now my net income to report is only $35,000. Now when this person makes $7,000 in capital gains, they realize that, oh, I also lost $5,000 on certain investments or certain trades. So now instead of paying taxes on $7,000, that's only $2,000, and it's only 50%, so I'm only taxed on $1,000. This person, they knew that they invested or they saved $5,000 in their RRSP, so they use that to deduct their income even further, and they also were diligent and kept track of their side hustle and the money that they made or lost, and they realized at the end of the year they lost $1,000 on their side hustle. So in this situation, person A and person B, they make the same amount of money. Person B only has to pay taxes on $30,000 of that instead of $47,000. So when we look to calculate the taxes owing on these incomes, both of them would fall under the 15% tax bracket for federal income. However, we also have to look at the provincial income, and now keep in mind these are 2020, but it won't differ that much, maybe just a few points of a percent. But we're just gonna say that this person is in Alberta just because it's really easy and I don't have to deal with the marginal tax brackets for this equation. But that'll be a total of 25% income tax, which is closer to the 30% that the average American pays that we saw earlier in the video. So person A would make or would have to pay $11,750 in taxes, whereas person B would only have to pay $7,500. So they saved $4,250 just from spending a few extra hours at the end of the year being diligent on their tax return. All right, now the last thing that you can do that will tremendously help you out is to tax the like button.
What?
No, but in all seriousness, I hope that something in this video stuck out to you, even if it's just one way that you can apply to your life that can help you save money. That's fantastic. And again, if you want clarification on anything that I've said, just ask me or let me know what you want clarification on in the comments. And I hope you guys have a great week.